Everybody, it's Rob Keens of GoldSilverPros.com. We are back. We fresh off of our trip out to Maryland to visit Silverback Precious Metals and Forsyth Engineering to take a look at bars, and we made some custom bars for Gold Silver Pros, which we will show you guys later. It's out on Twitter if you want to take a look. But today is on a record-breaking path. Sorry about that, guys, doing a sound check. Why gold is on a record-breaking path and why it seems to be dragging silver with it. There's one simple chart that explains the current move, but I think there are more charts that explain the longer term move. So we're going to get into a short version of this and then to a long version of what may happen to gold and what may be a key thing that's going to affect its price. And of course, when gold runs, silver tends to follow, but silver tends to follow higher and do more. And that's what we're excited about. And so if you like silver, stay tuned to this broadcast, because the fact that gold is going up is positive for silver as well. So we follow gold first when we have these big booms. And if you're a silver fan, we'll see that right after. All right, here we go with the presentation. We're going to jump right into it. And this is pretty simple stuff. We're just looking at a DXY chart. I've talked about the dollar index before. And for those that don't know what this is, the dollar index is an index of the dollar against a basket of other currencies or commonly traded. I think it's five other major currencies makes up the US dollar index. And so when this is falling, as you can see here on the screen, since about a month ago, in March, not quite a month ago, it coincided with the rise in the gold price. So if we look at the gold price and we look over here at, let's say we'll give that 60 days, you can see the gold price started going up right here in about mid-March. And then if you look over here at the DXY, it kind of went up and then down. So there is an inverse correlation in the short term. It doesn't always hold long term, but what it's doing is driving gold up. Right now, we're at gold at 2040.54, according to Gold Price. And it's 5:03 p.m. Central Time on April 13th, 2023. And of course, silver is 25.83, approaching that critical resistance line at $26. And what I mean by critical resistance line is silver has critical resistance at 24.50. It stayed above, so now we know we're in the bull run. At 24.50 was a critical level for me. It was a really big support level, on past trading periods, past things with silver. Now it's approaching 26. 26 is a huge technical level. If it stays and holds above 26 week-ending price, then I think you're going to see silver run towards 28. At that point, if gold is still strong. Now, if gold falls and silver's at 26, 26 will come back down, because silver's not going to run too far without its bigger brother gold. Gold's going to do it first, and that's really how that works. And what's driving, in the short term, the strength in gold and in silver subsequently is the fall of the US dollar index. Now, it's only fallen about 5 to 6 points since March, but you can see here that this is a low, and we've been falling since last year. So we go longer to date out on the chart. Let's say we do a 1 year. The dollar's basically been falling since its high in looks like September 26, 2022, September 27th at 114.10. And it's been falling ever since. It's been falling 1, 2, 3, 4, 5, 6, 7 months. And here we are. And gold has finally started to recover. If we look at gold over the last year, you can see that it was running pretty high, and then you saw a nice run up from November last year. So there's a big correlation. This is when the dollar index started falling. Gold went up and came back down. And then as the dollar index continued to weaken, gold went right back up. And so in the short term, the DXY, which is a measure of strength of the dollar against a basket of other currencies, not in relation to gold, tends to be inversely correlated to gold. Now, over the longer term, sometimes that breaks down, and I've done videos on that, but definitely in the short term, it looks like this is a big part of the process. And just to remind you guys, we do have a poll up. The poll question is, the dollar is crashing on bank news. Will gold take over? And that's a really, really good question. Will gold take over? It probably will. 75% of you say yes. And I think that is a potential outcome here. Thanks to Peter Furwine for being our channel moderator and riding shotgun. We appreciate it, Peter. Thank you to Caleb Fast, Tears for Beers, Daniel Kurek, Miguel Del Mario. Hopefully I got your name correct, Miguel. Daniel Kurek, who we said. Chuck Zero. Looks like Decibel MV. Colin Mann is here. Thank you, everybody, for being here. We didn't, by the way, have a broadcast on Tuesday because I was out in Maryland learning to cast bars. You guys follow us on Twitter. But we're going to, so that's why we're doing the live today. Okay, we're on the dollar index chart. I think I've told the story of that. But now I want to look at a little bit longer term picture. This is good for short term. Like I said, short term, the US dollar index strength or weakness can affect the gold price and hence the silver price. The silver is the little brother of gold. But there's something longer term, and it has to do with the Fed's balance sheet. Now we're here at Ardeni Research. This is put out by Dr. Edward Ardeni. He has a whole raft of technical reports that come out every day and every week on data, and he puts that out. This is today's data on the Fed's balance sheet. And we're going to talk about how the actions of the Fed may have put a fire under gold because they affected the dollar. And let's get into that. And I think that's a nice conversation. First, on figure 1, we want to look at total Fed assets, which has been falling basically since the end of 2021 and the beginning of 2022. This is total securities held outright. So we're looking at the red, and you can see that it's been falling and crashing down. And this is a big crash down. This is one of the bigger crash downs we've seen in history. So look back to 2008. I mean, it's basically been rising and plateauing. We haven't had a big fall since 2008. This is the last financial crisis. The Fed has continued to add to their balance sheet. Now, they did reduce a little bit 2018 to 2020. Then you had the pandemic, or they started increasing the pandemic, and then boom. And then finally, they're starting to fall again. This is what we call Fed tightening. The Fed will buy debt from the system to create demand for U.S. Treasury debt, and it supports the Treasury debt prices and interest rates and makes it competitive debt to the rest of the world. The Fed had built up quite a big bank since the last financial crisis, and especially since 2020 with the pandemic, which caused them to put a lot of liquidity in the system and to ease a little bit, and also to provide that liquidity. So what you're seeing now essentially is the response to all of that. They've started tightening. And that is going to be negative for the dollar and positive for gold. Why negative for the dollar? Because it causes bond rates to rise and increases risk in the system. We've now got an inverted yield curve where the 2-year U.S. Treasury is trading at a higher rate than the benchmark 10-year Treasury, which means investors expect an oncoming recession and negative financial news. That's kind of the expectation, and that's the indicator. And so what happens, we think we have an oncoming recession. The Fed is starting to slough off, or put back, it's in a tightening mode and it's sloughing off. Instead of purchasing new securities, it's sloughing them off. And that's causing weakness in the bond market, which of course is going to affect the dollar because the dollar's the other side of the bond. They're created through the same process. This is U.S. Treasury securities. You can see those have turned down sharply. You can see some of the agency debt and mortgage-backed security. Okay, this is not Treasury securities, but this is more in like the corporate space. These have turned down as well, but it's mostly Treasury securities, which have been dumped by the Fed. So the Fed's dumping a lot of treasuries more so than its agency debt and mortgage-backed securities. Here we go. Total loans. We see almost vertical at the beginning of 2023. Banks basically have been going to the Fed and requesting liquidity, and the Fed total loans had spiked up due to the banking crisis, other credit extensions, bank term funding program, primary credit. The Fed is issuing credit. People are taking it. And you see like a vertical line here on the chart. And of course, liquidity swaps spiked up during the pandemic. It has not spiked up yet, but I expect liquidity swaps maybe will come back up if we continue to see extended weakness in the market. And I think that's where we are with that. I'm going to go ahead and come back and check the chat, guys, and see how you guys are doing. Thank Great Nate for being here, and Tears for Beers, and Rick Zellner. Everybody is here. Looking at the poll, about 80% of you say the dollar crashing and bank news will gold take over. Agrees with that. And I think that's probably a pretty good indication of where most people are, including a lot of the bond traders, money managers, professionals in the space. Here's another neat little chart from Zero Hedge on the same story, and it's talking about money market funds. Now, I've addressed money market funds before, how we had a spike in those. People are going for liquidity. And what a money market fund is a super liquid fund, which you get some interest rate on, but you can access those funds usually without penalty pretty quickly, depending on how they're written. It's not like a bank CD or a long-term deposit. It's basically a short-term deposit. And what banks do is they take those money market funds and they go invest in riskier assets out in the market. Well, now you're seeing investment into money market funds because people are going for safety. And what they don't realize is that when you buy a money market fund, you think you're putting it just directly in the bank and they're giving you some interest rate with low risk investments on the back end. But on the back end, what they're really doing is they're loading it up with riskier assets. So that means it's a higher chance of default. If it's a higher chance of default, it may mean that we don't get the interest rate they were promised in the money market because the fund performance is not strong enough, or we actually lose money and some of those money market funds disappear. There's a risk to money market funds there because the rate that you get is the safe rate, but they invest it in risky rates, and the money market funds you put in is short term, you can withdraw at any time, but they take it and put it in longer term to get those higher rates into riskier investments. You don't get a higher rate in very short term. To get a higher rate, there's a couple ways to do it. You take more risk and you extend out the timeline, and a combination of those factors can tend to increase your yield. So here we've got the public loaning money to the banks, short-term, low interest rate, good for the bank. They get the difference between the interest rate of what they're paying and what they're getting on the back end. The problem is on the back end, they're going longer-term issuance, higher risk. And in a high-risk environment, it's not good to be in money market funds because it's a higher risk that they're going to default, or at least you're going to take a haircut or you're going to take a loss on that. So that's not necessarily the best thing to happen, but it totally makes sense why it's happening, because people think that they're going to safety. It's just that the money market funds aren't really, completely safe. And, we've demonstrated that in past episodes. I think 3 or 4 years ago, I did an episode on why money market funds aren't safe. That's the other risk, is that money market funds don't have high reserve requirements. So your average bank account has X reserve requirements, okay? And some of those were eased by the government due to the pandemic and due to factors after, the crash down last year. So, however, essentially on a money market fund, there's almost zero reserve requirements. So there's low reserve requirements on your regular bank accounts. Some banks, they have the provisions to take money in your bank account and sweep it to sub accounts, and then they put it into money market funds or into other investments. And they have less reserve requirements. So money market funds actually have less overall backing of reserves of actual cash that the bank has to hold than does your regular deposits. And those regular deposits don't have high reserves either. They're both considered very low. So money market funds for investors can be in a time like this where we're having liquidity issues and risk issues in the market. They can be the riskiest thing you put in, even though you think they're safe. So that perception that they're safe is what's driving people into these funds, even though maybe they're not quite as safe, as we think. And I think that's probably really what's going on here with, moving into the money market funds. And it's just an interesting phenomenon that I think is probably going to bite people in the butt later on. It's just that the average person does not know this. The average person does not know truly how money market funds work. The average person does not know in the banks how it's a trust account and they basically own it. You're the beneficial owner, and how there's counterparty risk to that. We've covered that before without me going deep into it, but that's essentially, the risk that I see there. So just to recap today before we go back and look for questions for you guys, and we're going to go back and share and just do a real quick recap of what's going on to wrap this up. Short term, the dollar has been crashing for quite some time. It keeps changing my chart here. We're going to go back. All right, it's been crashing since, we'll stay in the 3-year. It's been crashing since 2022. It's right now has fallen. It's about a half a point, looks like, to 101.01. It was 101.50, it looks like, to start the day. So it's down 0.49%. And gold has moved opposite in the same time frame. So you got November here, gold moving up. And you got earlier in the year, the dollar moving down from a high. I think it was at 114 at one point. And that's what you get, the inverse move. Although that pattern doesn't always hold up in the long term, meaning there are exceptions where they don't move it inversely. But in this case, it looks like that's driving higher gold prices, and gold is marching to its all-time high. And depending on what source you read, the all-time high could be 2074, 2069. I think there was a spike on the chart. Depending on how you measure it, it's about 2070-ish. We'll just call it 2070-ish as the all-time high in gold that occurred during the pandemic because of the risk. People saw risk, they went into gold. Silver's not anywhere near its all-time high. It's 25.83. And so if you look at silver's all-time high of about $50, I think it was twice that's happened. I believe it was 2011, right after the last financial crisis, and then early 1980s, I believe. I think, was it 1980 exactly when silver went up? But it was early, in that period. And that was after the big bout of inflation and high interest rates that we had in the 70s leading to the 80s, which is why silver spiked to 50 that time, because gold was spiking as well. I think gold went up to 850, silver went up. Anyway, we're headed towards that again, but it's not equal. You can see gold has moved more, and the gold to silver ratio is entirely too high. Gold is overpriced relative to silver because gold is getting close to its all-time high, and silver is about half of that. Gold's about 30, 40 bucks off its all-time high. Silver is, 50%. And so certainly it looks like silver may be the one to move more. And then going back to the Fed balance sheet, the Fed is rolling off, as you can see on this chart, total securities held outright. Strong move, strongest move since 2008 by far. Agency debt is not as much what they're moving off. They're trying to dump U.S. Treasuries. They're trying to get rid of U.S. debt and a little bit of the commercial debt, agency debt, and mortgage-backed securities. And then you see a spike in loans as banks and other institutions are going to get liquidity. So there's a rush to liquidity. Why? Because we also have a rush of liquidity to money markets. Money markets are considered shorter term liquid funds. That's why it's there. Okay. And that's what's happening. It's a rush of liquidity. It's a rush to short term. The market is starting to worry about a recession and it's going to safety. That's what this move is. That's what we're documenting here. The world is moving to safety. The big financial houses are moving to safety. And that's exactly, what is happening. Very interesting move. And I think this is setting up for a potential dollar crash. Now we're going to have to see what happens. If I say that, you're going to say when and how's it going to happen? And there are a lot of factors that we're looking at, but the dollar looks to be crashing down a little bit. Now, if we continue to get more negative banking news or negative earnings, or we have some sort of black swan, particularly related to financial institutions like banks or those types, then I think you could see another big push. Right now, we kind of see gold melting up a little bit, the dollar melting down, on just this overall sort of angst and worry about the state, not only of the dollar, but the underlying economic factors that affect the United States and affect the veracity of the dollar around the world and how people want to use it. And of course, underneath all that, you have the changing commodity trade, the Belt and Road Initiative, which excludes the United States, and the de-dollarization with China, Russia, and all, and now people in the Middle East and even other countries essentially getting out of the dollar. And that's another reason why the dollar is tanking a little bit, because some of those dollars are being dumped overseas, and that's putting pressure on the dollar because a lot of dollars out there, and if people don't demand them, the DXY is a sign of demand relative to other currencies. If people are using other currencies more, let's go back to the chart and let's explain this. Is a really, really good point that I need to explain to you guys. Really simple to explain something about the dollar. So we're going to go back here and we're going to go back to the DXY chart. When people are using more other currencies because trade agreements are set up in them, it increases demand in other currencies like the yuan, or the renminbi in China, the Russian ruble, Iran's currency, Saudi Arabia's currency. They've all been doing deals, and countries along the Belt and Road Initiative are taking loans out in Chinese renminbi, for example. So that's created incredible demand for Chinese renminbi. Demand for the Russian ruble has increased due to the war and Russia circumventing the sanctions and how they've done it. And they've tied, their energy to the ruble so that there's more demand for ruble. And other currencies around the world are getting a little stronger as well. Overall are getting stronger in that basket compared to the dollar. Why the dollar is crashing. And that's essentially the reason why people are dumping dollars and going into trade agreements and other. And it's just going to cause this long, slow sort of fall and the dollar. And essentially that's what's happened. That's kind of explaining what's happened short term and eventually long terms. I think we've got a good indication of why gold is where it's at. Great Nate says 2079 intraday. That could be correct. I think I saw a 2079 quote as well. Different quotes, different sources, but right at that. And if we get anywhere in that 27 to 2080 range, I think we can say, okay, we're pretty close to that high. And we can say, we've reached that new plateau. And of course, that would be important. And we're right on top of it. Again, silver's got much more room to run. Silver has all sorts of space to get out and run here. And I think if you're a silver investor, you have to be very positive. And if you're going to buy it, looking at the gold silver ratio right now, and you're asking, should I buy gold or silver? I probably would, stretch. I would stretch my dollars more over silver than I would gold, just because I think silver is going to come up more than gold as a higher percentage. They're both going to move up, but I think silver will probably move up quite a bit more percentage wise. So if you're just looking at percentage returns, silver has the higher upside, although it also has the higher or the lower floor, meaning it's volatile, so it can spike up more as a percentage of gold, but it also spike down. So if anything happens to the PMs and gold really just starts to fall based on news or an economic event or what the Fed is doing with the dollar, then you'll see silver crash lower. I don't expect that to happen, but that's generally how that works. All right, I don't see a whole lot of questions here, and I don't see any super chats on the screen. Let me read through and see some of the comments that we have. By the way, we had 250 people watching. Thank you so much for watching. If you have not subscribed to the channel and you want to comment, please subscribe, and you can come and comment in the chat, and you can ask questions, and I will answer the question as best as I can. It looks like you guys don't have any questions for, oh, I do have one from Kenny. Sorry, I found it, Kenny. Do you think the banking cartel will try and smash the price at the level? And I would say, yeah, they pretty much always do, because the typical pattern you've seen the last few years, at least, is as gold moves up 2% or anywhere near that, it tends to have a fall. It tends to come back down. Gold usually just doesn't run straight. It's not a straight line. And a lot of that is the trade on the COMEX and, you know, that action. And you can dump a lot of paper in either direction and cause the price to go up or low, higher or lower. And essentially, you know, that's the paper is how you're going to drive that. And, you know, if we look at the gold chart on CME Group, or the gold trading on CME Group, I think what we're going to see, if I can get there, we get there in a sec. I think what we're going to see is increased trade in gold in terms of the paper contracts, which is driving it up. Is that the overall indicator of the strength of the gold market? No, because it's paper trade. I think you also have to look at the physical. And when Ian comes on next from ARC Silver, we will talk about that, and we'll get the report from him about what's going on. Overall, I'm seeing fairly weak volume on gold and CME Group. So I'm not looking at the paper trade driving a lot of this up. I think it's not somebody spiking the trade up by dumping paper. Usually dumping paper is to the short side. Almost always, when you look on the chart, is just sort of stair-stepping up. People are coming in, and each additional contract is being priced higher. In fact, as I look at the settlement data for gold, it's up about $30 today on preliminary data for Thursday, April 13th. And on estimated volume of 190,000 contracts, gold settled an average of $20.5530 on the day, according to COMEX, $30.4 up. Of course, it's preliminary data, not full Thursday data, and we'll see that data tomorrow. On Wednesday, it moved up about $6. Relatively good volume, 228,000. So that's what's happening with gold. And I think we're seeing, you know, we're not seeing a lot of players come in and go long on gold on the COMEX, but we're seeing enough that's a strong move, and we're not seeing short dumping. I expect the short dumping to come, to answer your question. Hopefully that answered your question. We're going to present right now as well to talk about our partners over at ARC Silver. If you guys are interested in getting low-cost gold and silver, especially silver, ARC Silver is run by our good friend Ian Everard, who works out of his Jackson Hole, Wyoming shop. He is also the sole North American primary distributor for osmium, which is an interesting piece used in jewelry. If you're interested, go to Jackson Hole and see ARC. But if you're interested in getting access to silver and having it shipped to you, you can simply go to our website at goldsilverpros.com, go down here to the ARC section under precious metals deals, click on access deals, and you'll get this form, and you can fill it out, and just make sure to whitelist both invest@arcsilver.com and also this phone number, because that is how Ian is going to reach out to you. Just fill it out and put what you want, and then he will reach back out to you and provide you with what you guys are looking for. Again, this is lower premium silver and some gold as well than what you're going to find a lot of other places. He uses what he calls genuine spot, which is no bid-ask spread. You get the same spot number either side of the trade if you're selling or buying. And he makes an effort to provide lower premium silver where he can by buying strategically and holding it, you know, through the dips and the raises. And that helps him maximize the value of what he's getting premium wise from his stock. And what that also allows is for him to offer you lower overall premium. So that's a small, I think it's a pretty good one. If you're interested in that, just reach out to him. You can go right via our website. He'll call you back. Great guy. Been doing this with us for a long time. He was actually out in Maryland with us earlier this week with Jim at Forsyth Engineering. And we spent a lot of time, you know, making bars together and hanging out. And Ian's a really great guy. Okay, ending the poll. Dollar crashing on bank news. Will gold take over? 83% say yes. 17% say no. And that will end it with the poll. Thank you, everybody, for joining. Thank you to our channel moderator, Peter Frohwein, for riding shotgun and being there for us. Thank you to the 252 people that are here getting the gold report and doing the right thing, but looking at gold and silver and protecting yourself from what we think is going to be an economic crash, and also a crash in the dollar and a changeover into a new monetary system. You can protect yourself and thrive in that system if you know what to do. And the primary bridge is gold. Silver's there as well. And we'll continue to talk about that. Remember, we do have t-shirts. You look down below that are for sale. Silver is free, and the same design on our bar is now on t-shirts and hoodies. If you're interested, you can click on the link to go to Bonfire. That does help us. We sell that to help the channel and help pay the bills here. And we do appreciate those of you who purchase that and support the channel. Plus, you get a really cool t-shirt or a pullover, and they're very high quality. I have one, although I'm not wearing it right now. I wore it for the coverage we did out earlier this week But I think I'm going to order another one. I think I'm going to order a second shirt. I've got the high quality men's tee. It's really good. We also have a women's V-neck tee there if you want, and they all come in different colors and sizes. All right, that's going to do it for today, guys. Thank you so much for joining the channel and joining us today against April 13th, 2023. This is Rob Kientz.